Hi everyone, this is Mrs. V Chan. Welcome to my Form 5 Business Lesson 3. And today is 3rd of March 2020. Okay, so we will have chapter 4 today, which is Capital Investments Appraisal. So before we look at the detail, let's look at the meaning of appraisal. So here is the meaning of appraisal, which is the act of examining someone or something in order to judge their qualities or whether it is successful or not, or whether we need it or not. Okay, so in that case, appraisal is same as assessments and same as evaluation. Okay, so therefore in this chapter, what are we going to evaluate and what are we going to judge? So which is about capital investments. Okay, so for example, nowadays we lack of masks in Hong Kong and we need masks to protect us from virus or bacteria. So therefore, shall we buy our own machine to produce masks? So this is about the example here. So capital investments includes investment in tangible assets. What does it mean tangible? Tangible means with physical substance, for example, machinery, or whether we should spend money on doing research and development so that we can find medicine, okay, to save us from virus. So that is a kind of intangible assets. Are you okay? But anyway, these capital investments, okay, last for a long time, okay, which is more than 1 year. So we say that the decision here is a long time planning decision, and also at the same time the amounts we need to invest on machinery and research and development will be very large. Okay, you look at the word outlay here. Outlay means an amount of money spent on something. Spend on what? Spend on buying machine, spend on doing research and development, and the amount in this chapter investment is very large. Okay, so what happened if we made a wrong decision? Okay, and this wrong investment decisions will be very expensive and it may be irreversible. So whether we should make this investment or not, so think carefully. All right, so in this chapter, this is about the methods to assess or the method to evaluate whether we should invest in this capital investment or not. So therefore, if you are manager in the financial departments, you are responsible to make comparison and evaluate alternative investments projects, okay, in order to allocate limited resources and maximize the firm's wealth, okay, by using the methods you learn in this chapter, which is called capital investments appraisal. Okay, so next, let's look at the methods here for our evaluation and assessment. Okay, so we have 4 methods altogether. They are payback period, accounting rates of return, net present value, and internal rates of return. All right, and then we are going to group this into 2 categories. The first one is about ignoring time value of money, and this one is considering time value of money. So anyway, what does mean time value of money? Time value of money means $1 today is not same as $1 tomorrow. Is that right? But what about if we ignore time value of money? That means we assume today's $1 is same as tomorrow's $1, right? But actually, this is not true at all. So you can say that this first category, ignoring time value of money, will be disadvantage as well. Okay, so disadvantage. So one of the disadvantages for these 2 methods, they ignore time value of money. Okay, but what about if we consider time value of money, which is true in the real situation? So therefore we have net present value and IRR here. So therefore we can say this is one of the advantages, okay, in this category. All right. Okay, so let's look at the first method, payback period. So what is the meaning of payback period? Payback period means how long you have to wait for all your cash flows, all your cash inflows to be equal to the amounts you have invested at the very beginning. All right, and then of course you want to wait longer time or shorter time to get back your money. Of course you want to wait a shorter time to get back your money, right? So therefore this method measures the time required for a project's cash inflow to be equalized, to be same as the money you have invested at the beginning. All right, Now, under what situation you accept the project? So here, you have your predetermined cut-off period. For example, you can wait 3 years. All right, so if your project is less than 3 years, of course, you will accept the project. All right, so if the calculation of payback period is longer than 3 years, the predetermined cut-off period, then you will have to reject your projects. Okay, so let's look at the first example for payback period. That means how long you have to wait for the cash inflows to be the same as the money you have invested at the very beginning. So here is some information given to you. So here, annual cash flow. So there is a bracket for this 2000. A bracket stands for cash outflow. So why we have cash outflow? Because whenever we do investments, okay, on day one, we must spend money. So this is the amount of money we spend. So this cash outflow is same as initial investments, and then same as capital outlay. All right, and there's 1,000 here, so which is about how much? $2 million. So whether it is worth to invest $2 million in some project or not. Okay, so therefore to work out payback period, so after this column, annual cash flow column, you need to add another column. We say that cumulative cash flow, and then I just follow the dollar sign here and 1,000. Okay, in year 0, so this is 2,000 negative, so this is also 2,000 negative. But after 1 year, we have this 850 without bracket. That means we have cash inflow, and this cash inflow will decrease the cash outflow, and that will be 2,000 minus 850. So I will have 1,150, which is also a negative one. And year 2, I have another cash inflow which decreased the negative, so minus 550, so 600. Okay, and next year 400, so therefore I have 200 here. Okay, and when we come to year 4, this 500 turn a point here, so 200 minus 500, okay, so which is 300. So starting from year 4, I don't have any negative figure, so because it turns from 200 negative, 500 inflow to 300 positive. Okay, if I continue the story, so that would be 300 plus 350. So that would be 650. Okay, so this is about the cumulative cash flow column. All right, but what is our concern? So starting in which year? Starting in year 4 here, we get a what? We get a positive, okay? Okay, so therefore the first positive, we get it in year 4. But however, the exact year will be less than year 4, but longer than year 3. So how do we do that to calculate the exact payback period? It will be 3 years plus this 200. So this is the last negative. And then we have the coming cash flow in the coming year. So cash inflow in the coming year. Therefore, we can get the proportion. So this is cash flow inflow in the coming year, and then to cover 200, the last negative, so that the final answer will be 200 divided by 500. So 0.4. So the exact payback period will be 3.4 years. Okay, so this is the calculation of payback period. It means what? How long do we need to wait for the total cash inflow to be same as the initial investment here? Okay. Okay, so next we look at this column. So we have year 0 means now. Okay, and year 1 means the end of the first year. Okay, now here is the timeline. So this is year 0 means now, and this is year 1, and this is year 2. And actually, this one means what? The end of year 1. Okay, and actually the end of year 1 is the beginning of year 2. Are you okay? Okay, now we have another example to calculate payback period. And the information saying we have 2 projects here, project A and B, and they are mutually exclusive. That means you can only choose either A or B. Okay, now are you ready? So to work out payback period, you have to add another column, which is cumulative cash flow, and this is for project A. And then you add another column, which is cumulative cash flow for project B. So are you ready? So let's do cumulative cash flow for project A. So this is initial investment. We always have cash outflow, which is negative. So I use brackets. So that is 900,000. Okay, now after the first year, okay, we get this cash inflow. So this cash inflow will reduce the negative to 200,000. All right, and here another year. So to reduce this to 100,000. And in year 3, so set off, no more, so that we don't need to bother. So if we continue, yes, if we continue, or actually we can stop here or continue, doesn't matter. So we will get a positive figure here. Okay, so this is about how we do the cumulative cash flow column. Now we come to project B. So brackets means cash outflow, means initial investments, means capital outlay, so which is 1 million. All right, and here 600, so decrease the negative to 400,000, and 400, oh, no more, and this is 400 positive, again 800, which is positive, right? Okay, so therefore, which project would you choose? So how long do you need to wait for the payback period for A? So you need to wait for 3 years. But what about project B? Oh, you wait only 2 years. So the shorter the payback period is better. So project B here takes only 2 years to recover its initial investment. So with the shortest payback period is better, the company will accept project B. Agree with me? Okay, so therefore based on payback period, our choice is project B. But what about if we are willing to wait for 1 more year and choose A, and actually we get more cash inflow than B? So you can see this is another disadvantage for using payback period, which is ignoring cash flows after the payback period, and then together with another disadvantage, ignoring time value of money. So far we have 2 disadvantages for using payback period. However, of course, we have good things for using payback period. It is simple to calculate and easy to understand. So later on, if you go to page 5, you will have all the advantages and disadvantages for each method. Okay, so the next method is ARR, stands for accounting rates of return. And since this is also in group 1, so therefore it means it is also ignoring time value of money. Okay, and here you have the formula, which is estimate average profits. And what is meaning profit? Profit is the return we get from investments. So we say that profit is our outputs, and then the investment here is our inputs. So do you still remember one of the accounting ratios, ROCE, stand for what? Stand for return on capital employed. This is one of the ratios to measure the performance of a business. Remember that? So the idea is similar. So we have profit on top divided by the capital introduced as the investment by the owner. All right. Okay, so here we have example 3. Showing how do we do ARR. Okay, now we are considering whether we should buy this machine or not, and how much we need to buy. This is 400,000. Okay, and then this machine will last for 4 years, and there's no scrap value. That means no disposable value for this machine. Okay, and after that we are given income statement in the coming 4 years here. Now if we follow the example here, all right, so this will be the calculation. So on top, what I said, on top, will be average profits. So we have profit here. So profit after tax, year 1, 51,000. Okay, so year 2, 68,000. Year 3, year 4. Okay, take average, so divided by 4, because we got 4 years here. And then divided by, so what is investments? So this is the costs and the purchase price of the machinery plus 0. What does mean of 0 here? 0 means the scrap value. We don't have scrap value, and then we take average. Are you okay? So this is how we apply the formula to calculate ARR. Okay, and then if you use your calculator, all right, so the ARR in the calculation here will be 31.875%. Okay, so therefore, after we have finished the calculation, we have to make our choice to see whether we should buy the machine or not. Now, here is the condition. Should the company buy the new machinery if the minimal acceptable rate of return is 20%? What do you think? Now, ARR, the return is 31. So since the ARR from investing the new machine is, okay, 31.875%, which is much higher than the minimum acceptable rate, and this is the minimum acceptable rate, and which is 20%. Okay, what do you think? The company should invest in the new machinery. So this is how we use ARR. ARR stands for accounting rates of return to make our assessment and evaluation on whether we should do investment or not. Okay, now we come to net present value method, and this method is in group 2. That means this time we consider time value of money. So what is meaning of that? That means we have to convert all the future value to present value. Therefore, we do this discounting. Okay, as $1 today is not same as $1 tomorrow. All right. Okay, now we have the formula of net present value, which is equal to future value in year 1. Now we discount it, so divided by 1 plus R%. And then in year 2, and blah, 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 up to year end, depends on how long is the project. And this R%, we have these names, means the same thing. We call the interest rates, or cost of capital, or discounting rates. Right, okay. And what about a scrap value here? Okay, it means the disposal value at the end of the project life. So for example, if we are going to use the machine for 4 years, and then in year 4, we don't use the machine anymore. We don't just throw it away. However, we are going to sell the machine in year 4, so that this scrap value will be a plus. It means which is a kind of cash inflow by selling the machine. Okay, and finally, so why it is net? Because after we have all this present value change from future value back to present value, we're going to minus I naught. It means initial investments or capital outlay. Okay, so therefore we get the net answer here. Okay, so after we have calculated net present value by using the formula, we may get these 2 results. So net present value bigger than 0, that means we have a positive net present value, and this one will be negative net present value. So what is our action? So we will accept the projects if the net present value is positive. However, we reject the project when we get a negative net present values. And this is how we use net present value to do capital investment appraisal. Okay, so point 2 here, we have net present value compares the present value of all cash inflows and also the present value of all cash outflows. And then under what situation saying that the project is worthwhile to invest? That means when we have the net present value which is positive. Okay, so this is how we make decision by using net present value. Okay, so after that here, we have one example, which is example 4, okay? So there are 4 projects, project A, B, C, D. Okay, so here I have a typo. Okay, so that you change initial investment for D to 1.5 million here. All right, so, and also we are given this, the discount rate is 12%, and part A, we need to calculate net present value and see whether we should accept the project or reject the project. Okay, now here is the calculation by using the formula. So this is project A. So we have cash inflow here, 120,000 in year 1. So discount it back by using 1 plus 1, 0.12. So we get this. And then year 2, we have 250. All right, so that would be 1.12 square. And then plus this cash inflow in year 3 and discounts back to present value. And then cash inflow in year 4 and discount back. And finally, we minus 900,000, which is initial investment. So why we don't need to divide anything here? Because initial means right now, it is already at present. Okay, now this is important. So you need to use calculator to practice all the calculation in order to avoid careless mistake. Okay, and let me give you this net present value for A is 15,327. Okay, so similarly, so here we have the step for calculating net present value for project B. So, we have regular cash inflow in each year, so that 400,000 divided by this discount back to present, and 400,000, 400,000, 400,000, and minus initial investment. Okay, if you use your calculator, you will get this as the net present value for project B. Okay, so after calculation for project A and B, now I'm going to skip the steps and just give you the answer here. Okay, of course, you can practice and see whether you agree with my answer here or not. All right, so this is the calculation about net present value. Okay, now B, if the company has limited resources, determine which investment should be accepted by referring to the highest net present value. So before, okay, under what situation we will accept the project when the net present value is positive? So A is positive, B is also positive, and C is also positive, right? But the point is, since resources are always limited, we can only choose one. So when we choose, we always choose the one with the highest net present value. And in this calculation here, project A give us the highest net present value. All right, so this is how we make decision using net present value. Okay, now we have the last method here in this chapter, which is IRR, and it stands for internal rates of return. So how do we do that? So we have an equation here. So we start with FV1 divided by this, and then plus, and then plus, and plus scrap value and minus I naught. Okay, so is this formula familiar to you? This is exactly what? This is exactly the formula of net present value. And then we assume that net present value is 0 and solve the unknown. Okay, so we set this equation and saying that it is equal to 0, and then the unknown here is R percent, and we call this R percent as IRR. So this is the idea of using internal rates of return by setting net present value equals to 0, and the unknown is R percent, and the R here means IRR. Okay, you don't need to worry about the calculation for IRR, because in our syllabus, we don't need to calculate anything, but you need to learn the idea since the calculation is very, very complicated. Okay, so in our handouts about IRR, number 1, it is IRR is the discount rate at which net present value is equal to 0. So this is how we set equation to let net present value be 0. And then we solve the unknown. The unknown is the interest rate, and we also call this interest rate as IRR. And then since the calculation is too complicated, too tedious, okay, so therefore you don't need to look at the point here. You can just ignore it, and which is related to the calculation and which is out of syllabus. Okay, and then finally, all right, so for the remaining pages from page 5, 6, and 7, okay, so you just find me all the keywords from your textbook. So therefore in the next lesson, in the next video, I'm going to go through the DSE question with you. Okay, so keep working hard, and I will see you next time. Bye bye.